Greetings, everybody. This is Chapter 5, Video 1. Let's launch. Okay, folks, so today the learning objective is going to be apply the concept of realization. So when we talk about gross income, there's two concepts that really take place, and one of them is going to be the recognition of income, and the other is the realization of income. And the difference between the two is basically income is realized when you receive it. I mean, it is, and we'll talk a little bit more about it as we get into this video. But the difference between whether you recognize that income on your tax return or not is going to be subject to whether the tax law requires that you actually recognize it. Now, there's going to be two different ways that you will actually not recognize income that's actually realized in the person's life. And the first way is if it's excluded, it will be never taxed. And if it's deferred, it'll be taxed in a subsequent year. An example of excluded income that's never taxed is state and local municipal bonds. They won't recognize, they'll realize the income, but they won't recognize it on the tax return. It is actually exempt and will never be taxed during the time. And then deferred income is taxed in the subsequent year. A good example of that one would probably be 1031, where you exchange one piece of property for another piece of property under 1031. You'll defer that income until that second piece of property is sold. Unless you do another 1031, then you defer it again, so on and so forth. And I've actually had I had one client who actually had deferred, done 1031s on 6 times in a row, and just bought various properties as they needed it during the time. They were very effective in using it, and very much helped them out. So what is included in gross income? Under Code Section 61, gross income means all income from whatever source. That means, if you earn income in Saudi Arabia, you earn income in, Gabon, Africa, you earn income in Germany, you earn income here in the United States. Any income from any source is technically realized income. And so it has to be included in that, unless, again, when we get back to the recognition portion of this, if there's an exclusion or deferral that they don't have to take care of. Now, Regulation 1.61-A. So I'm kind of glad that they actually talk about this, because they have gross income, which, obviously, Congress wrote this law in that basically said gross income comes from any means whatsoever. Regulation 61 is going to take that, and they're going to actually kind of structure it a little bit more. And then they're going to say, look, it's, based on what we're seeing in this law, we've come to understand it as whether it's money, property, or services. So they take it and they expand upon it. And that allows the IRS to sort of define better as to how they're interpreting some of this stuff. And that's actually a very important concept you're going to see in law. Most of the time, what will end up happening is Congress passes a law, they deliberately make everything vague, and the reason why they make everything vague is because they really want to make sure that that there's some wiggle room in order to allow for some changing times if that ever happens, and things of that nature. So they don't have to go back and rewrite the law every single time when something new happens. That would be time consuming. It would be it'd actually be very bad for taxpayers, because they wouldn't know, is this really income or not? But if Congress passes the concept of it and the IRS pushes out the regulation that says this is what it actually is, actually works out pretty well for the taxpayer, so they can kind of get the idea of that. Taxpayers recognize income when they receive an economic benefit, when they realize the income, and the tax law does not provide for an exclusion or deferral. So economic benefit, what does that mean? So if I economically receive something, some sort of property rights in exchange for services or goods that I actually do, that technically is an economic benefit as a result of the transaction. An exception they put up here, which I think is very important, taxpayer recognizes, the borrowed funds represents a liability, not gross income. This is something that we actually run into a little bit. I'm not going to get too much into it till we get to deductions. But, this is one of the reasons why when you borrow money to buy a house and you pay back that money, you don't get a deduction off of your loan principal that you pay in, because the way the IRS looks at it is you never got any income from it. So you can't get a deduction as a result of that. And that kind of gets into the concept of the big balance sheet that we like to talk about in tax. So if I give you a deduction over here, somebody has to recognize some income over on this side. And as a result of that, that kind of gets sort of the thing. Now, there's certain exceptions where they don't follow that principle, but generally that's the principle that they're going to follow. If I give you a deduction over here, somebody's going to pick up income over here, and as a result of which, it's going to all balance sheet out for the IRS. It might not to the individual taxpayer. Obviously, the person who's getting the deduction is really happy. The person who has to pick it up as income is not happy. But from the IRS's perspective, all is equal. So getting to the realization principle, taxpayer engaged in a transaction with another party. So, for example, I have a keyboard here. I want to sell this keyboard to another person. I bought the keyboard probably for actually, I didn't pay directly for this. It came with the computer that came with it. But say I paid $20 for this keyboard and I sell it to a buddy of mine and I sell it to him for $25. What ends up happening is I've engaged in an economic benefit transaction with a third party. Therefore, I have income that needs to be realized as a result of that. Transaction results in a measurable change in property rights. I own the keyboard now. Later on, after $25 change hands, that person owns the keyboard. I don't have a right to use that keyboard anymore. Therefore, the transaction is complete. Realization principle takes effect. Now, recognition. Realized income is presumed to be recognized absent a deferral or an exclusion provision. Now, so what that means, going back to what we said before, if there's no section in the code that says, hey, you can defer the recognition of this or you can exclude the recognition of it, you're going to have to pay taxes on it. No ifs, ands, or buts. All right, so other concepts. Form of receipt doesn't matter. I would actually say, yeah, it can. So for example, if you're a cash basis taxpayer, when do I recognize or realize the income? When cash changes hands. If I'm an accrual basis taxpayer, when do I recognize or realize that income? When the earnings, when the process is complete and I have to go back to them and say, okay, here's my bill. You owe me money. Pay it to me, and life goes on. And so that's good. That, of course, that's when I recognize the income. So it does matter. Now, as far as form of receipt, I think another concept they're talking about this, property rights versus, cash versus other things. I mean, let's be honest. I don't think it really matters in that sense. In other words, if I swap this keyboard for, say, a better mouse, I've still gotten some sort of economic benefit. Whether, and of course, under the law now, under the new laws, they don't qualify for the 1031 treatment anymore. So unfortunately, I'd have to recognize it technically. Now, the return of capital principle. So if I go out and I buy a piece of land for $100,000 and then I go ahead and I sell it for $200,000, I'm going to be taxed on the difference between the amount received versus what we call my tax basis. My tax basis is how much I paid for that piece of land. Now, if I buy that piece of land for $100,000 and I spend $50,000 clearing out all dead trees and again, sprucing the place up and all that stuff with an intent to turn it into a campground, I get to add that $50,000 to the tax basis. It's considered a cost of owning the house. So that's actually going to be a very important thing that you need to understand there. That's going to increase my tax basis. When I turn around and I sell it for $200,000, now instead of $200,000 minus $100,000, I get $200,000 minus $150,000, which is going to give me my $50,000 of gain. All right, so the return of capital means tax basis is excluded when calculating realized income. I don't think that concept is difficult for people to pick up. If you have any questions, leave a comment in the comment box below, and I'll be happy to go greater into detail with this. Or if I have to, I'll go ahead and shoot another video, but hopefully it doesn't come to that. Return of capital but does not represent an economic benefit. If you think about it, if I pay $50,000 for something and then I end up selling it to somebody else at $50,000, I've recognized no economic benefit. Ergo, it's going to be a total return of capital, so I'm not going to be paying tax on any of that part. Gain from the sale or disposition of an asset is included in realized income, but it may not necessarily be included in recognized income. And again, we're going to kind of talk about that when we get to property transactions. Chapter 10, Chapter 11. 11 is where we're going to talk about dispositions, but you're going to get the tax basis number through the acquisition of the property. We'll talk about that in Chapter 10. All right, so recovery of amounts previously deducted. So if a taxpayer typically claims deductions in the year are paid, some deductions may need to be reimbursed or refunded. Okay, so this actually gets into what we call in the tax world a claim of right. Okay, so for example, let's see. Good example. I hire my staff and I'm going to pay them $100,000 a year. And by the way, my staff better not be watching this and thinking he's going to get $100,000 a year salary. That's not going to happen. But say I go hire another staff, a different staff, and I hire him for $100,000 a year. And I say, oh, okay, I'm going to pay you this stuff. But I'm expecting you, I'm going to pay you based on the hours you work, but I'm also going to pay you based on the business that you're going to bring in. And we've estimated that he's going to bring in, $400,000 worth of business. And so as a result of bringing in $400,000 worth of business, what he's I will create a compensation based on that. I get to the end of the year after I've paid him all this money, and I find out he only brought in $200,000 worth of business. So I go back to him and I say, look, you signed a deal that said you were going to give me $400,000. You owe me some money back. And so what's going to happen is I need you to pay me that money back. Well, what the IRS is going to say is, look, you're going to have, there's a claim of right that you're going to be entitled to, or that the employee is going to be entitled to, because they had to pay me back money that I had originally paid them. But because the money came back in a subsequent year, it's going to create a deduction for him to be able to take on his tax returns, to be able to reduce that income in a subsequent year. So that's important. I want to make sure that we follow all of that, and of course we'll use that. We don't talk too much about claim of right here. It's really an important concept if you talk to veterans. This is a major thing with veterans. It's also a big thing in international world, especially those who are tax equalized. But we'll not talk too much about that in great detail here. So the tax benefit rule, refunds of expenditures and deducted. Okay, so another, actually, and I want to talk about this. This actually, they say refund of expenditure. Another very common one that you're going to run into here is, say, for example, I got a client and I do their tax returns and they get $43,000 of itemized deductions. And in the following year, they get a refund of some of that money. I don't deduct that in the year that we're actually claiming the tax write-off. We deduct it in the year that the cash was received. That's a very important concept that we all have to follow here, and it happens. And the good news is, when you get to the firm, you'll do a couple tax returns, you'll get it. It'll be really fast. Actually, we're starting to see in our world now, this is becoming less and less likely because of the $10,000 maximum. A lot of people are paying are getting refunds that actually they received absolutely no economic benefit for, and as a result of which they're still they don't have to include it in tax income, but it is something we've had to do in the past. All right, so this is sort of an example. Courtney paid $3,500 in Ohio state income taxes, and she included this payment with her itemized deductions to file a tax return in March 2020. Courtney filed her 2019 tax returns as head of household, claiming $20,100 of itemized deductions, including $3,500 of state income taxes, $2,500 of real estate taxes, and $8,000 of mortgage expense, and $6,100 charitable contributions. Very generous individual. That's a very good thing. So she also filed an Ohio state tax return in March 2020. Discovered she only owed $3,080. So let's step back for a second. She withheld $3,500 from her pay. She ended up owing $3,080. So the difference between that, which I'm doing as an eyeball here, about $420, guess what? She's got a refund in the following year to deal with that. So when does that $420 become taxable? And the answer is all $420 becomes taxable and is required to include in her 2020 gross income, not her 2019 as a reduction on the taxes. She doesn't go back and file an amended tax return, which is kind of good because I would hate to be doing amended tax returns all the time just to claim refunds from states. So individual taxpayers so when to recognize income? Individual taxpayers file tax returns for a calendar year. Corporations, they say corporations you often use fiscal year. I disagree with that. I would say a good majority of them actually use calendar year, at least the ones that I've always run into. Now, fiscal year makes sense for certain people, but if it does, it does, and it doesn't, it doesn't. But I would say you're going to recognize it when you actually file the tax return, and that's the most important thing. But method of accounting is going to determine that. So if you're a corporation and you're an accrual basis taxpayer versus being a cash basis taxpayer, it's going to make a big difference as to whether you accrue, whether you recognize it in this year or not. So accounting methods, generally corporations are going to be accrual method of accounting, but if they're a small corporation, they can qualify for cash. Typically, with most of my clients, we tend to recommend the cash method because my personal opinion, you should be paying taxes when you got the cash, not when you're promised cash. I mean, people promise me cash all the time. Sometimes they deliver on time, sometimes they don't. And as a result of which, that's what we have to deal with. Individuals are cash basis taxpayers. Constructive receipt, taxpayers must recognize income when it's actually constructively received. So that is when the income is constructively received. So does that violate the principles of accrual method? And the answer is no, because the recognition of income is constructively received when it is owed to you, and therefore you will pay taxes on it at that time. And so that actually does not violate the accrual method of doing that. Deemed to occur when income is credited to the taxpayer's account. There are some rules, and we'll talk about this when we talk about accounting methods and corporations type stuff. When you do prepaid income, there is actually some deferral mechanisms you can use so that if, say, for example, I'm going to sell keyboards. I'm going to sell 10,000 keyboards. And I go to the company and I say, I want 60% of the cash up front, 40% of the cash upon delivery. And so they go ahead and they pay me the 60% of the cash up front. There is actually a deferral mechanism where I can defer up to a year that allows me to do that, even under the cash basis system. There is actually a way to do that. Typically in those cases, we like them to be an accrual system if that's the case, just because of the fact that there's going to be some of those issues if they don't. Generally in those cases, we're talking larger corporations anyways. There's not going to be a good reason for them to stay cash basis in that case. And then claim of right, income is recognized when there are no restricted use of the income. Again, no obligation to repay. So, for example, I get paid salaries for my company. Once the company strikes me a check for my salary, it's technically mine. I never have to pay it back under the law. Now, if I didn't own my own company, I worked for somebody else, or I work for GMU. So GMU says, look, Kevin, we're going to pay you to teach 4 classes every semester. And then one semester, they have to drop me in a class. So what happens is they say, look, we can come back and we can take that money that we were going to pay you, a portion assigned to that one class that we dropped. They can technically do that, at least under the law they can. I don't know if the university policies would let them do that or not. But technically speaking, there are some tax provisions that allow that. And again, we talked about claim of right a little bit earlier and how it was kind of important. So who recognizes the income? In addition to determining when the taxpayer realizes and recognizes, it's important to who recognizes it. It really comes in, assignment of income and community property system. So I'm not going to worry too much about assignment of income. That generally is more of an estate tax question, and gifting and things of that nature. There's going to be there's certain circumstances when you're dealing with the estate and gift tax areas where you're going to assign income, and we call those. Just to give you some extra terms, we have what we call a usufruct, which is basically a non-completed gift. So, for example, mom's getting old. She knows she's not going to be around much longer. She wants to give some depreciated stock to her kids. And as you know, because if she does it at date of death, it goes to fair market value. As date of death, it's depreciated. She doesn't want that to happen. So she's recommended to give the stock to her kids early. So what she can do is that she can say, okay, fine, I'm going to give the stock to the kids, but I'm going to attach a usufruct with it, which basically says I get all the dividend and income that comes off of it for the rest of my life. Therefore, once I die, the gift is complete. And then it transfers to them as a gift as opposed to an inheritance. That is actually a good example of assignment of income. You can also do community property systems. So, for example, I think it's 11 states. I'm forgetting, but I know like Texas, California, Arizona, I think Idaho. Don't quote me on that. I know Washington State is. I think Oregon is. But they're community property states. And if you remember from your business law class, community property states differ from common law states in the fact that, the community property kind of was the French system. Common law states was more of the English system. And one of the things that they do have in the community property states is that everything's divided 50-50 between husband and spouse. Or husband and wife, or husband, wife, depending upon the type of marriage that they have. So what ends up happening is that it's 50-50. goes to each one of the spouses equally, which is one of the reasons why California has very interesting divorce laws, because of the community property rules that don't exist in other states, and it's in that, and then in other things. So when you do file a tax return and there's a community property state issue, you could run into some significant areas. Because we're in Virginia, we're more likely than not you're not going to deal with it. I do a lot of California returns, so I have to deal with this every now and then. If you work in the tax industry, you'll probably deal with California on a regular basis if you work at a large enough firm, because it's just such a large state and everybody has so many ties to that state. I would say, you know, for the most part, if you run into that, review the rules with one of your seniors or managers, and they'll hook you up with all that. So the assignment of income, again, you know, doctrine of, you know, that the income, who earns the income must recognize it. But if it's assigned, you know, like I said, here in this case, income from property such as dividends and interest is taxable to the person who actually owns the property. Well, if you have an incompleted gift, technically the mom still owes it, but the son actually owns the stock. So that's kind of the assignment of that income. You can shift it. Again, like I said, there's certain estate and trust rules that you can actually do that with that make things a little bit more interesting. Again, if you run into that situation, you're probably going to have to do some research to be able to figure it out. Oh, there's 9 community property states. I apologize. Half the income, you know, and again, this is exactly what I talked about. But, you know, again, if you're working in this area, you're probably going to have to work with that. All right, folks, so that's all I've got for this video. If you have any questions, go ahead and leave them in the comment box below. And if you need to, reach out to me. I'm looking forward to seeing you in the next class.